أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله. We're going to start our discussion on chapter 5, which is it involves two things. One is the merchandising operations and the other one is multiple step income statement. So without going into a long introduction about what we are going to discuss, let's just jump into it. We have businesses where you have merchandising operations, meaning they buy the finished goods and they sell the finished goods. Here you have examples of Walmart, Amazon, Office Depot, etc. We have Lulu, Carrefour, Al Jarir bookstore. They don't make anything. They buy and then they sell. They buy a computer and they sell a computer. So this is called a merchandising operation, right? A merchandising business. And they have sales revenue. Now, you know this step from what we have in the accounting cycle exercise is that you have the sales revenue and then we subtract from that the cost of goods sold, right? You have prepared this multiple times. The result of that is something called gross profit. And then we have the other expenses which are called operating expenses, right? Those are subtracted from the gross profit and we get the net income, right? No magic here, all of you know this, yes? Now, we have two different types of companies that go through this process of selling and collecting from their customers. The first type we discussed, which is the merchandising company, which is showing at the bottom here, where we have buying of the inventory. So you have cash and you have the inventory is bought and we have recorded an entry where cash is paid and inventory is purchased, or inventory is purchased for accounts payable. You have recorded both of these types of entries. So that's the first step. You have the inventory and then you sell the inventory to your customers. You can either sell it for cash or you can sell it for accounts receivable. You will have receivable. It's payable for them, receivable for you. When you sell, it's receivable. And then they send you the payment. Either they send it to you immediately or they mail you the payment, however they pay it, or pay with a credit card. You receive the cash and then you take the cash and you go and buy more inventory. Simple. The other type of business is where you provide a service. You don't have something physical to give, right? So there you provide the service, like repair the car or clean the yard or do gardening, whatever the service is. And then either they have accounts receivable with you, you will either collect the money later or the customer will pay you the cash. Either way, you receive the cash and then this continues on, going on and on, right? Simple. You can stop me and ask me a question. I'm going to go through this first part a little bit faster because you have been exposed to this before, okay? Now, what happens, we have at the merchandising operations, we go back to the previous slide, just to point out one thing, that is this whole thing of buying the inventory and selling the inventory and getting the cash, buying the inventory, selling it to the customer, receiving the cash, this whole thing is called an operating cycle. This whole thing is called an operating cycle, right? The operating cycle for merchandising companies is usually longer than the service companies. The merchandising companies have a longer operating cycle than the service companies because you have to buy the inventory and wait. You go to Lulu, you see full of inventory. The shop is full of inventory. This inventory was purchased and they're waiting. Their cash is involved. They may have bought a bottle of shampoo 3 months ago and no one still purchased it from them, right? You follow? But if you go to the car repair shop, they fix your car There is no waiting after that. You pay immediately, right? If someone is providing with you security service, someone's providing security service, they're not going to go without a payment for 3 months. You pay them every month, right? So the service company operating cycle is shorter. It makes sense, right? Okay. Now, going back to the merchandising company, the service company accounting is easier because there is no inventory involved, and you don't need a lot of cash to start because you don't have to buy a lot of inventory, right? When I was working in the US, I worked for 8 years for this firm in Mississippi, and then I went on my own. So I opened up my own firm. I went on my own by myself, right? I rented a small office. I put a sign outside, right? And I advertised. That's it. All I needed was some furniture, a couple of computers, a sign, and some money to advertise. That's it. Now I don't have any inventory, nothing else. The customer comes, the client comes, I give tax advice, I prepare something for the client, takes me a week, 2 days, maybe an hour. I bill the client, get the money. Simple. You follow. Compare with opening a grocery shop or opening some business that requires inventory. So the accounting of the business that does inventory, right, that has inventory, is a little bit more involved, right? A little bit more work is needed to do the accounting. So what we have in this is, in every merchandising company, you would have some beginning inventory. The month does not start with zero inventory except if it is the first month of the business life. You follow? 1st of September, the shop, the supermarket, Lulu hypermarket started with some inventory, so they have some inventory. And then during the month, they're going to buy more inventory. So you have beginning inventory, and then you have cost of the inventory you purchased, right? You add those together, and what we call that is cost of goods available for sale, right? So you have 5 boxes in the beginning inventory, you buy another 5 boxes, now you have 10 boxes available for sale. You follow? Each one, if it costs you $100, you have $1,000 worth of costs of goods available for sale. Following? Then at the end, you will end up with 2 categories. One is those things you will sell, and those things that will remain with you, right? What is remaining is called the ending inventory that you did not sell, okay? And what you sold is called the cost of goods sold. So if you have 10 boxes and you sold 7, the cost of goods sold would include the cost of 7 boxes. The ending inventory would include the cost of how many boxes? 3. 3, right? Okay, simple. Now, there are 2 ways of doing the accounting inventory. The first one is called perpetual inventory, and the second one is called periodic inventory. The perpetual inventory, I don't know if you can see it here, or you have print out, or you have perpetual inventory is the one that we have done. I better go here, otherwise it will not be recorded properly. Perpetual inventory is the one that you have done where you record 2 entries for every time you sell. Remember the 2 entries: sales, cash, cost of goods sold, excellent, inventory, right? So you have gone through the exercise. This is now easy for you to understand, right? There is another type which is called the periodic inventory, where every time you sell, only sales are recorded. So you credit sales, you debit cash, and no other inventory entry is made. It is done all the way at the end of the accounting period. The inventory is accounted for all the way at the end of the period, not every time you sell. Okay? So, the first one is called the Perpetual Inventory System, right? Which maintains the detailed records of the cost of each inventory purchase and sale, records continuously, right? Show inventory that should be on hand for every item, and the company determines the cost of goods sold each time a sale occurs, what you have done, right? So we know the inventory is sold 3 times the cost. Remember? So every time you sell, you divide that with 3, you debit cost of goods sold, you credit inventory. This is perpetual inventory. This system is called perpetual inventory system, right? This is the more complicated one, and you know how to do it. Okay? This is the more complicated one. Because, just think about it, I gave you only one item, and I said it is sold 3 times the cost. Think about Lulu. Think about Lulu. How many different types of items they have, and how many different costs they have to keep track of, right? And how many calculations they have to perform. Because it is possible that they have purchased bananas for one particular rate during a particular week, and the price went up the following week or the following day. So now they have to keep track of, okay, these bananas, the cost is X. These bananas, the cost is Y, because the prices are continuously changing. Think about the petrol station. Petrol prices change, not so much in Qatar, but other places the petrol price changes with the market. You follow? There are other commodities that change, right? Remember, during the time of blockade, the items, the prices changed. There were items that they purchased before, which were for lower cost. Then they purchased some items later on, which were for a higher cost because the shipping is higher. You follow? So perpetual inventory requires you to record a cost of goods sold entry every time you sell, and think about the number of items you sell and the different amounts you paid for them. You follow what I'm saying, right? This is the more complicated one, because you have to calculate this, and the calculation is very complicated. It's not times the cost. The same customer is buying 50 different items, and they're different costs for each. You follow what I'm saying, right? Okay. Now, the periodic inventory system is very simple. It does not require you to keep any detailed records. The cost of goods sold is calculated at the end. The cost of goods sold is calculated at the end. So you have the beginning inventory. You add to that the purchases, and that equals to the cost of goods available for sale. This slide is showing the way it should show. Is it showing everything? In Blackboard, I think this is what you can do, but I can have the real slides open here. Okay, so this is the entire. You can see this, yeah. Well, okay, so let's do it a little. Okay, now you have the beginning inventory and you add to that the purchases, that gives you the cost of goods available for sale. This much you understand very simply. Whatever you had in inventory, you take that and you add all the purchases you made because it's recorded in your system, right? And then you have number which is called cost of goods available for sale. At the end of the period, you physically count the inventory. You physically take account of how much inventory is left, right? And you subtract that from the cost of goods available for sale, and that gives you the cost of goods sold. So whatever you had ready for sale minus what is left at the end equals to what is sold. You follow? Right? Beginning plus purchases equals what you have. So if I have 5 boxes at the beginning, I buy 5 more. How many do I have for sale? 10, right? Then I sell. I don't know how much I sold. I go in the end and I find how many boxes left? 3. That's my ending inventory. Because this is something that I can easily count. It's right there. That means how many did I sell? 7. You follow what I'm saying, right? So this is the idea. Okay? Say that again. This advantage of doing this is that you don't have to calculate the cost of goods sold every time you make a sale, right? Remember, to do that, you calculated sales divided by 3, and then you recorded cost of goods sold. Well, in real life, it's not that simple. The sales, you have a customer buying 1,000 riyals worth of items from Lulu. It includes 25 different items. Each one has a different cost, so you have to identify each one separately every time you have a sale. Think about how many sales Lulu has in one day. How many customers come, and how many different types of items they buy, right? So it's very difficult. This is usually done. The perpetual inventory is usually done for companies that have big items. For example, Boeing. Boeing, when they make one sale, for example, one plane, they can calculate that. You follow? That's a different type of business, right? The perpetual, right? The advantages of perpetual, let's go, we have this here, is that it is traditionally used for merchandise with high unit values. You see that here, Ms. Safia? High unit values, like I was saying, a plane or a ship, right? So when you sell a plane, it's millions, right? So you can calculate the cost of that one plane, no problem. But calculating the cost of a shampoo or a soap every time it's sold, it's just not worth your while. You follow what I'm saying, right? And you don't even have to be that precise, right? In there, you follow. And there are other methods of doing this as well, keeping track of the inventory items and so forth, and we'll come to that. This shows the quantity and the cost of inventory that should be at hand anytime. So when you do this, every time the inventory number is accurate. Every time you're debiting cost of goods sold and you're crediting inventory. So inventory is reduced every time you have a sale. That means anytime during the month or the year, you look at the inventory, it's accurate. The financial statement is showing the accurate amount of inventory. But in the periodic system, the inventory is only 100% accurate at the end of the period, right? And this perpetual inventory provides a better control over inventories than a periodic system. And you need to do that for big ticket items. But for the smaller items, it's just too much work, you follow? And it's not cost beneficial. So in accounting, we have a concept of cost benefit, and not in accounting, in any business you have this. In any business, when you're trying to make a decision, should I do this? Two things must be looked at. What is the cost and what is the benefit, right? If the benefit is more, if the benefit is big enough for you to pay the cost, then you should do. If the benefit is too small and the cost is too high, right, then you should not do. Even with accounting principles, this is true. We call this, in accounting terminology, substance over form. Substance over form. I'll give you an example. We have a truck that the university buys, and it will be used for 5 years, let's say. Normally, we would depreciate that, right? We would record that as an asset, and we would depreciate that 1/5 of that over a period of 5 years. This garbage can right here, right? Sure, this has been here for at least a couple of years, if not longer. Right there, this garbage can. You follow? This is not just for 1 month or 1 year. This has been here for some time. It costs 100 riyals. Take the 100 riyals, put it as an asset, divide that with 5, then divide each one with 12 and record depreciation every month. Doesn't make sense. You follow what I'm saying? Although the thing will last more than 1 year, so we will expense it, right? We will record that as an expense, although the thing will last you for a period of time. So every company has an amount below which, if the amount item is below that, it is not recorded as an asset. Now, last time I checked, the amount for Qatar University was X. I want you to take a guess. What is that amount? So Qatar University's accounting system does not record as an asset if the item has a price below this number. What is that number? 1 million. 10,000, you're getting close. 8 is the other way. 20. It is 20,000. If the item is 20,000, so this computer, this projector, they are not recorded as assets. You follow? They are expensed. This table chair, although this table has been here for 9 years, this table, right, this one, this exact table, I've been looking at this thing for 9 years. That chair for 9 years, 2011 fall, right? The first day of class was September 25th in 2011, okay? So what is today, 15th? Okay, 10 more days, right? And students would have sat in these chairs for, but it's expensed, it's gone, you follow? You cannot depreciate this thing for 9 years, you follow? Okay. Now, continuing on, recording the purchases of merchandise. The way it's done is usually there is something called a purchase invoice, right? There is a purchase invoice. Either the purchase of merchandise is for cash or on account, right? If you're buying something on account, then the entry would be to debit inventory and to credit accounts payable. Very good, right? With every accounts payable, there should be an invoice like this, right? From the supplier who's selling you the inventory. So we have an example here where South Stereo, the buyer uses a purchase invoice, the sales invoice prepared by PW Audio. So the purchase invoice of one company is the sales invoice of another company. Because when there is selling, there is buying, both sides involved. You follow? So we're looking at it from the buyer's side. When we're looking at it from the buyer's side, you have recorded entries where you have debited inventory and you have credited payable. All of you have seen this entry, yes? So we have 3,800 debit to inventory, 3,800 credit to payable. Now what happens, to throw a twist in the story, there is sometimes shipping involved. Listen to me very carefully. because this is a concept that some students have a difficult time grasping. There is shipping involved in some sales. Either the buyer pays for the shipping or the seller pays for the shipping. So think about this. We have baladna. Everybody knows baladna. They bottled milk. They manufacture that. Well, they process that, not necessarily manufacture. They have cows and so forth. They pasteurize the milk and so forth. They bottle it. They're the seller. And you have buying the milk, who's the buyer. And in between, there is shipping. Truck bringing the milk from Baladna to Lulu. Who's going to pay for this? Okay? If the buyer is paying for it, then we call it FOB shipping point. FOB shipping point means free on board shipping point. Free on board shipping point means the buyer is taking responsibility as soon as the item goes to the shipping company, right? The shipping company is paid by the buyer, right? Think about it this way. Think about it this way. The buyer sends a truck to get the item, right? As soon as the truck driver gets the item, anything happens after that, the seller is not responsible because the truck is paid for by the buyer. This is called free on board shipping point. At the point of shipping, it is free for the seller, right? And the ownership transfers to the buyer as soon as the truck driver receives the item. Clear? Right? Contrast that with FOB destination, where the seller is paying for the item. The truck belongs to the seller. So something happens on the road, it's not the buyer's responsibility, right? When you order something from IKEA, something happens on the road, it's their truck, right? So the ownership is not going to change until the thing reaches the buyer's destination. You follow? Who's paying? Who is? Who am I? No, this case, the seller is paying for it. In the first case, the buyer was paying. So when the buyer is paying, as soon as the truck gets the item is buyer's. Anything happens on the road, it's buyer's, because buyer is responsible for shipping, right? But FOB destination, right, it is free at destination. That means who's paying for the shipment? The seller. So until the truck reaches the buyer's place, the ownership does not transfer. Anything happens on the road, if IKEA's truck get into an accident, they will say, oh, you have to pay for the item, sir, I'm sorry, our truck got into an accident. So it is nonsense. I'm not going to pay for it. You follow what I'm saying, right? But if I go and pick up the item from Lulu and I have an accident on the road, I cannot go back to IKEA and say, look, I had an accident, to change this item for me. It's nonsense. It's you who's paying for the shipment. You took it and it's yours. You own it. You follow. So when the buyer pays for the shipping, it is FOB, free on board shipping point, right? It is free at the shipping point because the shipper, the seller, does not pay for the item. Clear? Right? Okay. So what happens? How do you account for this payment? Assume upon delivery of goods on May 6, South Storio pays Public Freight Company $150 for the freight. The entry for this company would be inventory and cash. Any amount paid to get the inventory to your location is also classified as inventory. So if you purchased an inventory item for 1,000 riyals and you paid 100 riyals to get it shipped to you, that means your inventory cost is 1,100. You follow? So if the buyer is paying, they will pay for the shipping and it would be recorded as inventory debit, cash credit. Are you following? Although the inventory price is less. But when you calculate the cost of goods sold, this item is also going to be calculated. If you're buying anything that you need to pay to get the inventory to your place, it will be included in the inventory. This is clear? Yeah. So anyone wants to explain this, what I just said? Anybody who understands? Anyone, you can volunteer. I need a volunteer to repeat what I said about this, what to do. Ms. Safia.
And the delivery was to 100, all of them 1,100, we need one transaction as a mentioned. If you are going to pay the same thing.
You follow?
The price of the good, the item plus the shipment.
Yes, everything. Right. Think about it this way. When you order pizza and there is a delivery charge, right? The pizza man comes. No, you may pay for the shipment to a third party. It may be paid to somebody else, right? There is a shipping company. So Amazon, FedEx or DHL, somebody involved in the middle, you're paying them. But this is not recorded as a shipping expense. It is recorded as inventory. You follow? If you are buying. Clear?
It's two different, so you're paying for inventory from the seller and you're paying for the delivery from delivery company. Can you put on the same entry?
If it is at the same time, you can, but it will be two different lines. So it will be inventory 1,000 and it will be inventory 150. You follow? And there will be this, right? This is this, the reason different, right? So it's paid to different people. Plus it will have the description here. So in real life, you will have description here, inventory and the name of the company you paid, and then inventory, the name of the company you paid, and there may be another note that's inventory in parentheses shipping, inventory in parentheses goods. You follow? But it will go to the same line item in the financial statement. It will be in the inventory line on the balance sheet. Right, many, there will be many lines. You follow, right? Okay. If you are selling, however, then it would be recorded as debit to freight out, which is basically shipping charges, right? Freight out is basically shipping charge, okay? And then cash. So this will not be recorded as your cost of goods sold. It will be recorded separately. You can add that to calculate cost of goods sold later if you so wish, but it is initially recorded separately. Is that clear? The second one, if you're selling and you pay for shipping, you record that as a shipping cost. Debit separately, right? So when you're selling inventory, you record sales and you record cash. If you're following perpetual inventory, you debit cost of goods sold, you credit inventory. And if you're paying for the shipping, you debit freight out and you credit cash. Is that clear? Okay. Now, after the purchase, there are two different items that are involved if you return something. If you return something, then an entry has to be made. If you return the purchased item, then you have to make an entry to reverse purchase. If you get a reduction in price, this is called a purchase allowance. So let's say the seller sold you some items and they also shipped. On the way to your location, somehow some of these items got damaged. You take the item, you open the box, and you find some damaged goods. You call the seller and you say, I have some damaged goods. I'm supposed to get all items brand new without any defects. The seller says, if you keep it, we'll give you a discount. This is called purchase allowance. You follow? So may choose to keep the merchandise if the seller will grant a reduction in price. Are you following? Right? This happens quite a bit if the pizza's late in the US.
So only in case if I like it, and this doesn't happen, and actually this.
Usually, yeah. Otherwise, whatever you agreed to, you have to. If they give you what exactly they said, so if you call the pizza company usually and the pizza's late, because of that it is cold in the US. Here it doesn't happen. If you do, then you can, right? It is possible that you get free. It is possible that they give you a 50% discount. The driver has the authority to give you up to a particular amount of discount. You follow? They have to call and they have to, no sir, it's not allowed and so forth. This is not something that they do, okay?
Like this applies only when the payment is done after the purchase.
The payment is always done after the purchase when Lulu is buying from Baladna. Okay, this is the type of transaction we're looking at, one business buying from another business. This can also happen if you paid for the item. You follow what I'm saying, right? For example, I bought a phone, right, from Lulu and it didn't work well. You follow, right? It would, heat up and it would not keep the charge and so forth. So Lulu could tell me that we'll return you 100 riyals if you would keep it, and you deal with the situation, or there is a crack somewhere after you open, there is a crack and so forth. Lulu might say, if you keep it, we'll give you 100 riyals credit, you can buy anything from the store, right? So it can happen. This is also purchase allowance, right? It can happen post sales as well, but usually when the transaction is between two companies, the payment is always later. You follow? The trucks are coming from Baladna every week, 2-3 times, and the payment is usually made from Lulu to Baladna once a month. You follow? Right? Okay. So if you return the goods, then if you return the item, when you purchased it, you debited inventory and you credited accounts payable, right? When you purchased it, you debited inventory and you credited accounts payable. When you're returning the inventory item, you would reverse, right? You would debit inventory, you debit accounts payable and you would credit inventory. I have good news for you. Yes. What is the good news, Mr. Adi? Anyone knows what the good news is for him? Lecture is recorded. Okay? You can thank Mr. Adil for that, alhamdulillah. So the lecture is recorded, whatever we have discussed so far. Who said lecture is recorded? Salah, smart. Okay. This entry is clear, yeah? Okay. I give you a lot of pizza examples because I delivered pizza for 4 years for Pizza Hut when I was a college student, okay? So I know a lot about how it works and so forth, and I can make pizzas and so forth. So you hear me talk about a lot of stuff in terms of accounting, right? And then the 8 years I worked as an accountant, also I did restaurant accounting. So you'll see me going back to restaurant examples a lot because I have 12 years of involvement with working in the restaurant as well as doing accounting and consulting. So you'll see me going back there quite a bit. Say that again. Is good?
Everyone is using it actually.
Baladna example is good. Very good. Have you ever been to Baladna?
Yes.
Yeah? How do you like the smell? rough. Anyhow, my car, right? I have 4 children, and my car smelled like balata for a long time. Right? So they were everywhere in Balata, and then when they came, and the ride is quite a bit, right? If you come back, you have to sit in the car for quite some time, right? The thing, my car, inside my car just smelled like Baladna for some time. Anyhow, uh, the companies give you something called a purchase discount if you pay within a period of time. So the companies encourage the buyers to pay on time. They're willing to give them a discount to pay on time. And these terms, the payment terms, are given at the time of purchase. So for example, here we have 210 and 30. This is an example of a discount term. What does this mean? It means you will get a 2% discount if you pay within 10 days. And if you pay within 30 days, you have to pay the net amount. You have to pay the whole amount. So let's say you buy something and that is 100 riyals. You pay within 10 days. How much you have to pay? 98. Buy something for 100 riyals. Pay within 10 days. If you have this offer, then if you pay within 10 days, you only have to pay 98. If you pay within 30 days, which is from the 11th day through the 30th day, right? After the 10th day, you have to pay the whole amount until the 30th day. So you have to pay, maximum time is 30 days, but if you pay within 10 days, 2% discount. This is what it means. You follow? You cannot exceed the 30 days, but if you don't have money, what can you do? You get into something else which is handled by the lawyers, right? So we stop here and then let the lawyers handle if they don't pay. You follow what I'm saying, right? Then there is something called 110 EOM. This is read, this is the way we read it is 210 and 30. You follow? So when somebody says, when an accountant says the credit term is 210 and 30, 210 and 30 means 10%, 2% within 10 days, net amount if paid within 30 days. 110 EOM means 1% discount if paid within first 10 days of the next month. So let's say Baladna is sending trucks after trucks to Lulu in September, right? Every week, 3 different items are coming in trucks, right? Milk, etc., etc. And they're sending them a bill, right? And the bill says 110 EOM, meaning by the 10th of October, if they pay, the bill is 1% discounted. No, next month. You see, it says days of next month. EOM means end of month. You follow? Next month. So 110 EOM means you have 1% discount until the first 10 days of the next. So whatever the bill is, the month is showing in the bill. If the bill is sent to you in September, that means you have until 10th of October to get the 1% discount. If the bill is the date of October, anytime in October, 10th of November, you follow? Not 40 days, always. Because think about it. Lulu is continuously buying from Baladna. Every week, maybe 2 times, the trucks are coming, right? For Q-Bake, the trucks may be coming every other day or every day. You go there, you find fresh bread every day. A payment is not made every day. So yes, the shipment that was made on the first day, you have 40 days. But the shipment that was made on the 15th, you don't have 40 days. You follow, right? So it is reducing, okay? The credit card, exactly. The credit card, you continue to charge the credit card throughout the month. And then you have 1 day, right? You follow? So if you charge the last day of the month, right, you have the shortest time to pay it back. If you charge the first day of the month, you have 45 days, let's say. You follow, right?
This will always have to be set at the end of the month. So I will calculate the figure of 1% discount from the beginning.
The 1% discount is the item that you purchased. You calculate the discount on the item, not based on days. So let's say during the month of September, you purchased 1 million reals worth of goods from Balada. Take a discount if you pay within the first 10 days of October. First 10 days of October. Anything you bought in September, if you pay within first 10 days of October, 1% discount.
So the bill would be monthly?
The bill in these cases, yes. Most cases the bill is monthly. You follow? Right? There used to be in olden days some restaurants and so forth in your local neighborhood and so forth. If you went there and ate, you don't pay every time. You just eat there and they keep what you ate and so forth. And again, I'm talking about during the times of my grandfather and so forth. This type of business is not available. I remember eating on account of my grandfather. So he had like in different places he had books and so forth. I just have to go there and say I am his grandson. You can eat and so forth. He will pay the bill at the end of the month. You follow? So I remember me and one of my cousins who used to do that, right? And sometimes the guy would be scared that we are just eating so much. My grandfather pay. But this type of business is no longer. I mean, maybe in the villages they have it, but this was not uncommon. I'm sure if you ask your grandfather, right, he will tell you, right? So there is usually like 100 years gap between the person and his great-grandchild. So my grandfather was born in 1907 and my daughter was born, right, my second child, 2007. You follow what I'm saying? So this is her great-grandfather. So 100 years, you have 4 generations, right? My grandfather, my father, myself, and my daughter is 100 years. Anyhow, so what happens now here? Assume that the company pays the balance due, right, on the 14th of May, which is within the discount period. So remember, they initially bought $3,800 worth of items and they returned $300. So now they have to pay $3,500. The way this is recorded is you have to use the entire accounts payable. The entire 3,500 accounts payable will be reduced. You have to debit accounts payable. You cannot leave any accounts payable, but you're only paying 3,430 because that's 2% discount from this 3,500. So you're not going to pay the entire cash. You're going to pay the cash, which is 2% discounted, and the rest will be reduced from your inventory, right? The rest will be reduced from your inventory. Is that clear? Right? Because now your inventory is no longer costing you 3,500. It is costing you 3,500 minus 70. Is that clear? And if they don't take the discount, it's simple, right? If they don't take the discount, you debit cash and you credit. I'm sorry, you debit accounts payable and you credit cash, right? If they don't take the discount. Is it clear? Come on, man. If they don't take the discount, debit accounts payable, credit cash. Finished. Finished. So you see, they're paying within the 10 days. So you have to see when does the discount period start? Are they paying within 10 days? If they pay within 10 days, you record the discount. If they go past the 10 days, then there is no discount. Is that clear? Okay, very good. Okay, now 2% discount. What is 2% discount? Why do we worry about 2% discount? Why do we worry about 1% discount? It could be a lot of money. Just think about it. the amount of inventory Lulu purchases, if they can take a 1 or 2% discount on all of those items, it's millions. It's millions, right? Yes. No, it could be anything that you arrange, right? It could be anything. This is not, there is, what you're getting here, Mr. Adil, is an introduction to everything. You follow? We could just talk inventory for 15 weeks. You follow? So this is not, nothing is everything. Just, there are, let's say, 50 dishes, you're taking a spoon and you're tasting one spoon from everyone. You follow? There is a lot more. You follow? And let me tell you something. I have a PhD in accounting, yeah. If you take all the accounting knowledge, everything that is known in accounting, and you put it inside a box, I only know 10% of it. I have a PhD in accounting. You follow what I'm saying, right? So, this is your first class in accounting. There is no everything. You follow what I'm saying? There are many things written by other accountants, other professors. I read, and it's like Chinese to me. I have no idea what the guy is trying to tell me. You follow? Because it is just so outside my area. You follow? It's just so much. You follow? That one individual, one academic cannot get a grasp of it. I could write something, right? A research paper or an article and so forth, and say things, it would be the same way to that person. You follow? Because this is not his area. So it's just too much. You follow? This is just an introduction. Okay. Now, it's usually a good idea to take the discount because it adds up. Now, here is the inventory account. You see, initially we purchased 3,800. We debited the inventory. Then, everybody knows what a T account looks like. You have dealt with T accounts many times. So what happens? If you return the item, you credit 300, right? Then you paid $150 here for the freight, which adds to the inventory. Anything you pay to ship the inventory to your place when you're buying, it adds to the inventory, and the discount is subtracted. Clear? Okay, this is the inventory T account. Okay. Now, when you are selling, right? This is what we did when we purchased. Now, when you're selling a merchandise, you either sell it for cash or you sell it for credit. If you sell it for cash, then you debit cash. If you sell it for on credit, then you debit accounts receivable, right? If you are doing perpetual inventory, then you record these two entries, all of you have recorded multiple times. Cash, debit, sales revenue, credit, accounts receivable, debit, sales, credit, right? Going with that, remember the inventory is sold, in our example, it's always 3 times, right? The idea is to get this thing in your head by doing it multiple times. So now this is no longer a difficult concept for you. You have debit to cost of goods sold, credit to inventory. But this is done in what type of inventory system we said? What is the inventory system? Perpetual, right? Remember, the periodic inventory is where you count the inventory at the end of the period. That's why it's called the periodic inventory, because the inventory is only correct, it's only accurate at the end of the period. Perpetual inventory means perpetually, continuously the inventory is correct. You're always adjusting the inventory every time you make a sale. What type of business did we say this type of inventory system is good for? Big ticket items, right? The individual items are priced, high priced. You follow? Not for supermarkets and so forth. Okay. So let's take a look at an illustration. Here we have the other side, right? This is the seller. Same transaction from the side of the seller. So what the seller did is recorded sales revenue 3,800. Remember, the inventory was sold, right? We recorded inventory and cash. Now we have sales revenue and accounts receivable. This is from the side of the seller. Okay, they will record. So it's given to us that the cost is 2,400. This is provided, right? This is provided to you. You don't have to calculate anything. So cost of goods sold 2,400 and inventory 2,400, right? Debit cost of goods sold, credit inventory. You're familiar with this journal. You've made it many times, yes? Everybody following? Simple? Okay. Then we're talking about the purchase returns and the purchase allowances from the side of the seller, right? What happens when there is a purchase return and what happens when there is a purchase allowance, okay? You follow? On the other side, what do we do there? We have reverse the accounts receivable because we are no longer going to get the accounts receivable. So we debited 3,800 to accounts receivable. Now we credit 300 to accounts receivable. Are you following? We're reducing the accounts receivable by 300, but we do not reduce the sales by 300 when we are selling. We have another account which is called sales returns and allowances. This, please listen to me and remember this. This sales allowance and returns and allowances account is called in accounting term a contra revenue account, C-O-N-T-R-A, contra, because it contradicts the revenue. It reduces the revenue. So you sold 3,800 and you have to subtract from that the sales return and allowances of 300 to go to net sales. Why do we go through this complication? Why do we put another line and call it? Why don't we just reduce the sales? Why don't we just debit sales and forget about it? To track, because if we have a large amount of sales returns, that means what? Somehow our customers are not satisfied or our goods are not that good. We have a problem. You follow? Usually the sales returns is a very, very small percentage of sales. And if it goes, if it increases, you should be able to look at it and it should ring a bell, alarm should go off that something is wrong, right? Customers are returning the items, they're not satisfied. Okay. And the other entry is just reversed. So instead of inventory, credit and cost of goods sold that we did before, we reverse it. We reduce cost of goods sold and we add the inventory back. Are you following? Okay. In the case of allowance, yes.
Maybe I'm confused. The previous slide, you said that we also do the opposite for the cost of goods, but actually the cost of goods when we give discounts are not affected, right?
They are. They are affected. This is not discounts. This is, I'm getting the inventory item back. This is return. I'm getting the inventory item back. So I did not sell. So if I'm getting the inventory, cost of goods sold also is reversed, right? In the case of a defective item, right? So here it says, assume the returned goods were defective and had a scrap value of $50, what would they do? So let's say the item was returned and the item was initially sold for 300. The item initially sold for 300 and the item is defective. The customer is returning and the item is defective. So the first entry remains the same. The customer is no longer going to pay 300. So we credit 300 and we debit sales, returns, and allowances. But we cannot add 300 back to our inventory because the item is defective. Follow, the item is defective. We can only put a $50 value to the item. So we will add the inventory back, but it will be added at $50 instead of 300 because it's defective. Are you following? So it is the item that you're taking back, whether it's in good condition or whether there is a problem with it or not. You will notice if you ever return something to a supermarket, they will ask you, is there anything wrong? What is wrong? We have a form that they fill out that this button does not work or this something. So they decide based on what you experienced whether this can be fixed and sold as a new item or this has to be sold as a scrap item, a discounted reduced item. You follow, right? Sometimes you will see that there are some items where the box is broken and there is tape on the box and so forth, and you will see that item, although the item inside is fine, that broken box, just the packaging, is reduced, right? Why? To get the customer to buy that. You follow, right? So every item is looked at whether it can be sold for original price or it has to be reduced. Based on that, you record this. All right? Scrap value is something reduced, a reduced price, right? Scrap value, some scrap items are sold at a reduced price in, how should I say this? What is the proper, I don't want to say the terminology they use, a market where branded items are generally not sold. For example, let's say Nike is preparing, is making a shipment of shoes, right? Some of them come out as defective, right? And they cannot be sold in the supermarket or in the mall for 500 riyals, right? So what they do is they take the logo off, they take the Nike logo off, and they sell it to a second-hand market in China, right, where this thing is sold for a lower price, and Nike's name is not associated with. That's a scrap product. You follow? It's not, outlet has several meanings. Anybody been here? Anybody been to China or any country like that? If you go to China, there is a market where all brand items are sold that have slight defects. For example, you can buy like a very, very expensive suit, for example, for 1/3 the price or 1/4 the price because one of the buttons was defective or it was of different color. Somehow there was a mistake and it is too costly for them to fix it. They just sell it to the second-hand market. They will tell you that this is Apple. They will tell you that this is Nike, although the brand name does not show there. You follow, right? But it is the rejected products, but the rejected are not that kind where you cannot use. You follow? It's slightly damaged. It's slightly damaged, right? Exactly, it does not meet their standards. It's slightly, right? And you can buy, if you go to China or Vietnam and so forth, you can buy a lot of stuff for very little. They're branded stuff. You follow? Okay. Say that again. This is something that they have to, this is given to you. You don't have to decide that. The seller decides what they can sell it for. Okay, they have methods, they have ways of doing that. So you return something and the box is broken, give you 10% discount. You follow? So they have a method of doing that. They have a method of discounting. Okay. Okay, so now we have three different things going on here. The sales revenue was recorded at $3,800. $300 was returned, and then you have the other entry, which is the sales discount, which is also recorded as a separate item. Debit sales discount. Without looking, let's say, who can tell me what would be the credit when you do sales discount 70? The $70 credit goes where? Where the credit amount goes. When you're debiting sales discount, the credit goes where? It goes to accounts receivable, because you're no longer going to get that. You follow? You're no longer going to get that. Initially, you recorded the entire amount as accounts receivable. You're no longer going to get the accounts receivable. So it's not recorded as a separate line item. This is how it's recorded. So if they pay within the 10 days, you have to reduce the entire accounts receivable by 3,400. You debit cash for 3,430, and the discount is 70. Okay, so the 2% discount is again recorded as a separate item. You want to see how much discounts you're giving. Okay, you want to see how much discounts you're giving to your customers. Are you following? So when you calculate the sales, it is sales minus sales returns minus sales discounts, and it equals to net sales. Okay, sales is credited, sales return is debited, sales discount is debited. Does that make sense? Okay, let's go on for 5 more minutes and we'll take a break, inshallah. Actually, this is a very good time to take a break. We are going into the next concept, which is a single step income statement. So let's take a 10-minute break and we'll come back.